really decent numbers once again. I remember moving here several years ago and people said to me, we can't keep doing this. 200K every month is not sustainable. Then we kept doing it. Can we keep doing it, Larry?
Yeah, I think we can, Jonathan. Look, you've had a big change in economic policies. You know, the president has moved to lower tax rate incentives, heavy deregulation, removing these burdens from all the sectors of the economy, opening up energy, trade reform. We're looking at, hopefully, a USMCA deal that will be very pro-growth. That's a very high priority. So the bottom line is you're getting blowout numbers on jobs, like today, 263 plus, upward revisions. You got a blowout number on first quarter GDP. You had a blowout number yesterday with year-on-year productivity, 2.4%. You know how important that is for the health of the economy, for wages, and for an absence of inflation. And let me just reiterate that point. What we're seeing is low unemployment, 3.6. I think somebody told me it's the best since the late 60s. Low unemployment, strong growth, and virtually no inflation. So all those Phillips curve models should be buried, and we should look at a new world. People respond to incentives. That is exactly what's happening right now, and the economy is freer than it has been in 20 years plus.
So, Larry, the data is looking really good, but you've said yourself today that you think the Fed is looking at cutting interest rates. Why do you think they're looking at that?
Well, I think that the Fed model here, look, the Fed is independent. I'm not preaching or anything like that. The Fed model looks to me like it's changing. This is just my personal view. They're looking at inflation and the lack of inflation. They're not worried about real growth, which is terrific. They're saying, hey, wait a second, we might want to be targeting the inflation rate. And if inflation continues to moderate or to remain low, I think they should look at reducing their Fed funds target rate. And I think they will, over time, on their own time schedule, on their own actions. The independent Fed will eventually lower their target rate because we don't have any inflation to speak of. So not only is this a new model of the economy, replacing the old Phillips curve with supply-side incentives, I think it's a new approach by the Fed. I think Chairman Jay Powell is moving in that direction. I think Vice Chair Rich Clary is moving in that direction. So that's a good thing.
That's not the sense that a lot of people got this week. Chairman Powell used the word transitory, that this soft patch would fade as the year grows older. Larry, is that a mistake?
Well, we will see. I'm not going to guess, Chairman. We will see. Again, our point of view is low unemployment can coexist with virtually price stability, virtually no inflation. And, you know, what you got here is a supply curve pushing out, Jonathan, right? You got GDP, jobs, real wages, productivity. You have business investment, which I think is about to pick up again. Core CapEx, durable orders up 10% at an annual rate in the first quarter. That's a big number. I think as the incentives kick in, the capital deepening kicks in, that pushes the supply curve out. And that's, I think, what the Fed is taking notice of. That is counterinflationary. So let's pause for a minute. If inflation is too much money chasing too few goods, but we're increasing the supply of goods and services at an unexpectedly rapid rate, that's counterinflationary. And so my hope is the Fed will take notice of that. I think markets have already taken notice of that.
Well, I think we're all looking very closely at how the reaction function of the Federal Reserve evolves as the year carries on, Larry. Another thing we're focused on is just the complexion and composition of the FOMC, who gets which seat. It was really interesting how it played out yesterday. We had Stephen Moore, a good friend of yours, I know, come on the program here at Bloomberg and interview with us. And he said he was really looking forward to going through the nomination process. He was hopeful he would secure it. Then 2 hours later, he withdrew. I'm trying to understand what happened in the hours after that interview, Larry. Can you give us a little bit of insight, some colour?
Actually, I was unaware of the interview until later. Steve Moore called me Wednesday evening, I guess it was, and said he wanted to withdraw, that he and his bride just couldn't stomach the personal attacks. And, of course, I'm very sympathetic to that. He had a pretty raw deal, if you ask me. But in any event, he pulled out late Wednesday evening. I spoke to the chairman of the Senate Banking Committee later that evening. I spoke to the president early the next morning, and we put out a tweet. Our tweet maybe could have gotten out earlier, but we had that beautiful prayer ceremony that Mr. and Mrs. Trump were leading. But we got that out. So we knew about that. Stephen had made his decision Wednesday night.
Why 24 hours later, less than that, would he come to Bloomberg, Larry, and say that they were all in? The administration was all in, he was all in. Why would he have done that?
Jonathan, I don't know. You'll have to ask Steve. I asked him not to say anything publicly until the president could weigh in. Perhaps he was observing that suggestion, but I don't know, and I don't think it matters.
There's something about this process that is odd to a lot of people. The Republican leadership in the Senate, Larry, didn't seem to be on board with some of these picks over the last couple of months. Do you think the process is going to evolve a little bit, where there would be closer discussion between Senate Republicans and the administration over who the president chooses next to nominate?
Well, look, we always have close conduct. We always have close discussions. The leading senators on the banking committee, for example, are, frankly, old friends of mine. We talk all the time. So sometimes nominees come forth, and as you know, Steve Moore was not a formal nominee. His name was announced, but he was in the vetting process, so he was never formally nominated. Things pop up. That's about all I can say. In his case, you know, he's a good guy. He's a great economist, pro-growth economist, dear friend of mine. He took a lot of personal attacks on matters that have no bearing on his views or standing where he have gone to the Federal Reserve Board. So it is what it is. But I will say this about my pal Moore. In terms of the battleground of ideas, he got the story right. I mean, he's been arguing for many years, as we all have, with the right incentives.
Yeah.
You can have strong growth without reigniting inflation. That was his argument. That kind of upends some of the conventional wisdom in certain institutions in this town. But I think Steve won that battle. Over 100 economists endorsed him. Professor Jeremy Siegel of Penn wrote an op-ed in his, et cetera, et cetera, et cetera. I give him high marks on winning the battleground of ideas.
Are you saying, Larry, you'd be willing to nominate someone unconventional once again? Because in the past you've gone with people like Marvin Goodfriend and Nellie Lang, and they didn't even get a hearing. So would you be able to go with someone of the mould of Stephen Moore, Herman Cain once more? Have another go?
We've been interviewing a bunch of highly qualified candidates, and we will continue that process, and we'll be coming up with some names before too long.
If the president called you into the Oval Office, Larry, and said, Larry, you're the man, would you serve on the Fed?
He's not calling me in. He hasn't asked me to go on the Fed. I am blessed and grateful to have the job I have as director of the NEC. Frankly, it's the best job I ever had, and I love serving under this president. So I just will let's not go there, John.